Hey friends, Lucian here with the Bullish Bears team. This video is going to be about the differences between calls versus puts when trading options. If you're new to the world of options, each options contract is made up of either a call or a put or a combination of both, depending on what type of option strategy that you're doing. If you're doing just calls and puts in and of themselves, that is called naked. So you're buying a naked option without any type of protection, whether you're buying a call or buying a put or selling a call, selling a put. If you're not combining it with any other type of combination of calls and puts together, you're just buying or selling naked options. So that's where it comes in, the terminology where people say, well, options are risky. Like any trading strategy, options are a risky trading strategy, but it's only if you don't know what you're doing. There are times that you can trade naked options, and it's a great strategy. It's just you have to know the time and the place on when to do each strategy. So, when you're doing naked options, you need to be directionally biased. You need the market to go either up or down. So when you're buying a call, right? So there's calls and puts. When you buy a call and you're an options buyer, that means you believe the price of the stock is going to go up. So you're directionally bullish. You have a bullish direction or bullish bias. When you buy a put, so you're an options buyer and you're buying a put, you believe the stock is going down. So you have a bearish bias on the stock. So those are buying strategies. You buy a call if you believe the stock is going up. You buy a put if you believe the stock is going down. Now, again, when you're doing options, whenever you're an options buyer, there's always a seller on the other end. And the vice versa is also true. If you're a options seller, there's an options buyer on the other end. So when you go to sell a call, so you're selling a call to somebody else, it's just the inverse of buying a call. You believe the stock is going down, you're just selling it to somebody else. So you're selling to the options buyer. So you sell a call if you're bearish on a stock. And then you sell a put if you believe the stock is going to go up or you're bullish on the price of the stock overall. So again, let's just do a summary. Naked options are just being a buyer or a seller of a call or a put. You buy a call if you are bullish on a stock. You buy a put if you're bearish. You sell a call if you are bearish on a stock, and then you sell a put if you're bullish. That's, again, only if you're doing naked strategies. These are the foundation or the building blocks moving forward moving into things such as debit spreads, credit spreads, iron condors, stuff like that. So let's talk about some of the risks associated with buying and selling calls and puts. When you buy calls and puts, when you're an options buyer of a call or a put, the risk is defined. And you can only lose the premium that you paid. So whatever you pay for the options contract as the options buyer, that is the most that you can lose on that trade. Now, when you are an options seller, so let's say you're selling calls, the risk is undefined because a stock can go to infinity. There's no amount, right? There's no ceiling on how high a stock can go. So when you're selling a call and you're believing that you're bearish, right? So you sell a call and you're bearish on the stock, that price can explode and go up to whenever. That's why to wherever, that's why the risk is undefined. Now, when you sell puts, again, still extremely risky doing it naked, but it is defined because, a stock can't go below zero. So you're selling a put because you're bullish on the stock, but again, price can't go below zero. So it's defined risk, but still very risky if you're going naked on selling puts. It's undefined on, selling calls because, price can go up to infinity. So again, a lot more risky being an options seller naked. Being an options buyer naked is still risky because you can lose all the premium that you paid as well. Because remember, options do have an expiration date. So every options contract has a date that it expires. So as a buyer, you need to either sell it before that expiration date or exercise your options contract Again, so you have to make a decision before your expiration date. So that's, the risks associated with, buying and selling, calls and puts. And just remember, calls and puts are the absolute foundation in the building blocks for every options strategy.